You believe the due date protects you. You believe that as long as you pay on time, the system recognizes discipline and rewards it. You believe punctuality equals safety. But the due date was never designed to measure safety. It was designed to measure predictability. And predictability serves the bank before it serves you. Most people follow the printed calendar without questioning what it actually controls. They assume the due date is the central reference point in the credit system. In reality, it is only one visible marker inside a much larger structure of reporting cycles. Liquidity modeling, risk scoring, and revenue optimization. This is not about personal finance habits. It is about how timing is embedded into the architecture of modern credit, and how that architecture quietly redistributes power. To understand why the due date matters less than it appears, it is necessary to examine the two internal clocks that govern every revolving credit account. The first clock is the billing cycle. The second clock is the reporting cycle. The billing cycle determines when interest begins to accrue, when the statement balance is calculated, and when the minimum payment is defined. The reporting cycle determines when your balance is transmitted to credit bureaus and integrated into credit scoring algorithms. These clocks are not aligned for your clarity. Most cardholders assume that paying on the due date maintains optimal credit standing. In the narrow sense of avoiding late fees, this is true. But the balance reported to credit bureaus is usually captured on the statement closing date, which often occurs days or weeks before the due date. This distinction rarely receives attention. If a large balance is present at the moment the statement closes, that balance is what gets reported. Even if it is paid in full by the due date, the credit bureau may have already recorded a higher utilization ratio. Utilization ratio influences credit scores significantly. Higher utilization signals elevated risk. Elevated risk adjusts pricing. Pricing determines cost of borrowing across the system. The illusion of punctual safety begins to weaken here. The due date satisfies compliance. The closing date determines exposure. Few consumers notice the difference until their credit score declines despite paying on time. Late realization is embedded into the mechanism. Interest compounds daily on revolving balances. If payment is made exactly on the due date, interest has already been accruing on the statement balance for weeks. That revenue is predictable. Predictability stabilizes earnings models. Earnings models support capital ratios. Capital ratios determine lending capacity. Lending capacity expands systemic leverage. Leverage increases fragility. Fragility demands more precise data. Precise data requires continuous monitoring of payment timing, balance fluctuations, and behavioral patterns. The due date becomes a behavioral anchor. Banks do not only track whether you pay. They track when you pay, how much you pay relative to the balance, how frequently you revolve debt, and how close you approach your limit. Patterns are more valuable than punctuality. Patterns feed internal risk algorithms. Internal risk algorithms determine credit line increases, promotional offers, balance transfer eligibility, and risk repricing. Long before public credit scores adjust, from the consumer's perspective, the relationship appears binary, paid or unpaid. From the institution's perspective, it is probabilistic. Probability drives securitization. Credit card receivables are bundled into asset-backed securities and sold to investors. Those securities are priced based on expected payment streams and default rates. Timing consistency across millions of accounts enhances confidence in those projections. If millions pay on predictable dates, liquidity modeling becomes more stable. Stability reduces funding costs. Reduced funding costs increase margins. Margins support further credit expansion. Expansion fuels consumption. Consumption sustains economic growth. The chain is rarely visible. The due date participates in it quietly. When economic stress emerges, subtle shifts in payment timing may signal household strain. Increased minimum-only payments, delayed payments within grace periods, rising utilization near statement closing dates. These signals are aggregated. Aggregated signals adjust risk projections. Risk projections influence capital allocation. Capital allocation influences credit tightening. Credit tightening rarely arrives with explanation. It appears as account review, line reduction, or increased APR. The consumer perceives personal consequence. The system responds to collective data. During the 2008 financial crisis, rising consumer delinquencies were early indicators of systemic stress. Credit card charge-offs increased gradually before broader recognition of crisis severity. Banks reduced credit lines across millions of accounts to preserve capital. They did not wait for widespread defaults. They recalibrated in advance. This is how structural erosion works. It does not announce collapse. It adjusts margins. The due date does not shield against recalibration. If macroeconomic conditions deteriorate, even perfectly punctual payers may experience tightened limits. The illusion of control fades slowly. The mechanism gap remains open. Why does the system present the due date as central when the closing date governs reporting? Because clarity increases compliance. Compliance stabilizes revenue. Revenue supports leverage. Leverage underwrites growth. Growth maintains confidence. Confidence masks fragility. The presentation is simple. The structure is layered. Credit scoring models rely heavily on utilization and payment history. Utilization reflects reported balances relative to available credit. If balances remain high at the moment of reporting, scores decline even if the account is paid off days later. This dynamic encourages consumers to carry lower balances before the closing date, though most are unaware of that nuance. Unawareness preserves asymmetry. Asymmetry benefits institutions. Interest revenue from revolving balances remains substantial. Even modest differences in payment timing across millions of accounts generate meaningful variance in interest income. Interest income supports capital adequacy. Capital adequacy satisfies regulators. Regulatory satisfaction preserves systemic confidence. Confidence enables further debt issuance. Global debt levels have expanded consistently for decades. Household credit is a core component of that expansion. As debt rises relative to income, sensitivity to interest rates increases. Rate increases transmit quickly to credit cards because APRs are variable. Higher APRs amplify daily interest accrual. Daily accrual increases dependence on timing. If balances remain high longer within billing cycles, interest revenue rises. Revenue increases even as consumer stress increases. Stress feeds risk models. Risk models adjust exposure. Exposure reduction may appear as responsible lending. It also restricts consumer flexibility. Flexibility erodes gradually. When flexibility declines, reliance on credit deepens paradoxically. Minimum payments extend debt duration. Extended duration increases total interest paid. Total interest paid enhances bank profitability. Profitability sustains shareholder expectations. Shareholder expectations drive institutional behavior. Behavior shapes product design. Product design emphasizes simplicity at the surface. Complexity remains beneath. Consider how promotional interest rates function. 0% introductory periods encourage balance transfers. During those periods, utilization may spike. Once promotional periods end, interest rates adjust sharply. The transition often coincides with statement cycles rather than due dates. The difference is procedural. Procedural differences generate revenue. Revenue stabilizes balance sheets. Balance sheets underpin the financial system. The consequence gap widens. If millions were to alter payment behavior, significantly paying earlier relative to statement closing dates, reducing balances before reporting credit scores might improve marginally. Improved scores reduce interest margins on new loans. Reduced margins affect bank profitability. Profitability influences capital accumulation. Capital influences lending capacity. Lending capacity affects economic growth. Small behavioral shifts aggregate into macro implications. This is why timing matters beyond individual accounts. It participates in systemic liquidity modeling. Liquidity modeling influences shadow banking structures that finance credit card receivables. Asset-backed securities depend on predictable cash flows. Deviations in payment timing, if large enough, alter yield expectations. Yield expectations affect investor demand. Investor demand influences funding costs. Funding costs transmit back to consumers through APR adjustments. The loop closes quietly. It is not necessary for consumers to coordinate for the system to adjust. Minor statistical deviations prompt recalibration. Recalibration reduces risk exposure. Risk exposure reduction may mean reduced credit lines even for compliant users. Compliance is necessary but not sufficient. Safety is collective, not individual. The structural loss of control emerges here. Individuals follow rules designed for revenue stability, not personal optimization. The due date becomes a symbolic reassurance. Symbolic reassurances stabilize behavior. Stable behavior underwrites leverage. Leverage magnifies fragility. Fragility necessitates surveillance. Surveillance deepens asymmetry. Most do not realize that payment timing feeds machine learning models predicting default probabilities. Slight deviations in payment rhythm, frequent minimum payments, balance oscillations alter internal risk scores. Internal risk scores influence decisions long before public credit scores reflect change. The asymmetry is quiet. In periods of tightening monetary policy, central banks raise rates to control inflation or currency pressure. Credit card APRs adjust rapidly. Household budgets compress. If households begin stretching payments closer to grace periods, algorithms detect it. Detection triggers caution. Caution reduces credit availability. Reduced availability increases strain. Strain affects consumption. Consumption affects corporate revenue. Revenue affects employment. Employment affects repayment capacity. The cascade is gradual. It rarely appears linked to a calendar date. Yet timing participates. In earlier monetary systems, convertibility anchored trust. Under the gold standard, paper notes could be redeemed for metal. As long as redemption requests remained manageable, stability persisted. When redemption demand increased, convertibility was suspended. The suspension did not erase currency. It altered its meaning. Similarly, the due date does not erase risk. It shapes perception. Perception shapes behavior. Behavior shapes systemic resilience. When households believe punctuality guarantees protection, they may underestimate structural recalibration risk. Recognition often arrives after limits shrink. After APRs rise, after promotional offers disappear. The recognition is quiet. It does not produce headlines. It produces confusion. Confusion erodes trust incrementally. Trust erosion rarely collapses systems immediately. It accumulates. Accumulation leads to transformation. Credit systems evolve to protect institutional stability first. This is not malice. It is design. Banks must preserve capital to survive. Capital preservation may conflict with individual expectations of fairness. Fairness was never the core metric. Risk containment was. As debt saturates economies, risk containment intensifies. Payment timing becomes one of many inputs, not the decisive one. The decisive factors lie in aggregated behavior, macro conditions, and regulatory frameworks. The due date remains visible. The closing date remains decisive. The gap between visibility and decisiveness defines asymmetry. Asymmetry defines power. Power determines who absorbs volatility. Consumers absorb interest variability. Banks absorb statistical risk. When stress increases, banks adjust faster. Consumers adjust later. Late realization reinforces structural imbalance. This imbalance does not announce itself dramatically. It reveals itself through small cumulative shifts. Lower credit limits, higher minimum payments, subtle score fluctuations. Repriced risk. The calendar remains unchanged. The architecture shifts beneath it. Understanding this does not dismantle the system. It clarifies it. The due date was never the center of the credit universe. It was a behavioral tool within a liquidity machine. A visible rule in an invisible framework. Recognition of that framework does not produce panic. It produces awareness. And awareness replaces illusion with structure. The structure continues to operate, quietly, gradually, according to incentives that extend far beyond a single printed date. That is how modern credit systems function, not through dramatic deception, but through layered design. Design that aligns predictability with profit. Design that transforms punctuality into data. Design that protects institutional stability first. And by the time most understand this, the recalibration has already taken place.